why should investors, and especially young people, believe that stocks and stock funds are where they should put their retirement money?
You know, you step back and you ask yourself, long term, do you believe that, you know, we still have a robust economy and we're going to be productive as we go forward, and the markets are going to reflect that? And I see, you know, despite all the negativity that we've experienced the last couple of years, I see no reason to be pessimistic over a 10-year period. And so I'm actually pretty optimistic about stocks in general. And I would say the U.S. markets probably more so than many other people are.
Well, there are a couple directions to go from there. One has to do with time horizons. We often hear the argument that stocks are the best investment in the long run. What a lot of people wonder now is the long run too long for real people?
You know, I think when you look at the way people behave, a very fair question. I would say, importantly, stocks should be a component, and if you're younger, a larger component. But I think even for somebody 22 years old with a 60 or 70-year time horizon, you still need to be balanced. And you should be balanced across stocks. You should be balanced across bonds. You should have some money in cash. You know, today cash yields almost nothing, but you still need to have, you know, your broad asset classes covered. I also think it's very important to be diversified. You know, while I'm optimistic about the U.S. market, there's so much going on in the rest of the world. You need to be diversified there as well.
Right. That's a great point. I think most people don't really know what diversification means. They think it means having a broad selection of U.S. equities, but that's only a narrow slice of the total assets of the world.
I'll give you just a simple example that I've used with some of our clients. So Wellington Fund, which is Vanguard's oldest fund, it's celebrated its 80th birthday last year. Wellington Fund is a classic balance fund, 65% stocks, 35% long-term bonds. And over the decade ended in 2009, its average return was somewhere between 4 and 5%, something like that. Now, that's below its long-term historical average return of about 8, but it's positive, well ahead of inflation, with two of the worst equity markets in history.
Right. For that period, it's excellent.
Yeah, and the point is, if you're well diversified, you may not see the great ups, but you're going to protect yourself a little bit more on the downside.